Hello, in this presentation we're going to enter a reversing entry related to accounts receivable within QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. Here we are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're working on reversing entries here, and the entries that we are reversing are some of the adjusting entries, those entries made at the end of the time period, usually a month or a year, in our case, the month of February. We're reversing those in order to separate the two functions, one being the normal day-to-day processing function to move logistically well as compared to the month-end process to make the financial statements in accordance with the accrual principle as closely as possible. To see those concepts, let's first take a look at our reports here on the left side. We're going to first go to the balance sheet report, and we're going to take the report for our range of dates, which is 01/01/21 to 02/28/21. That's January 1st, 2021 to February 28th, 2021, and run that report. So here's the report that we have. Now remember our goal, here's the dates up here again. Remember the goal that we have here is to have everything correct as of the cutoff date. So we want everything correct as of February 28th. That doesn't mean we're not concerned about any other date. It just means that that's the date we're making the financial statements as of, and therefore we want to make everything completely accrual based correct as of that date. Some things logistically work well to not exactly be an accrual basis all the time. One of those things might be our billing process. So our billing process, we might say, hey, we got to bill every 2 weeks or so because we have to count up all the bills and all the hours and then bill somebody. And the time it takes to do that might mean that our normal processing cycle may be 2 weeks later after we actually do the work. The problem with that is that from an accrual standpoint is that QuickBooks recognizes revenue when we create the invoice. And if we created the invoice, in our case, in March, when the work was actually done in February, QuickBooks would record the revenue in March when we really need it in there in February. We need the increase in the receivable in February. Even though the invoice didn't go out, we earned the revenue and people owe us that money at that point in time. And the other side is the revenue side. We earned it. Now, in our case, we ship guitars, so we would typically look at the point in time that the guitar was shipped to the owner, and if that happened in February, even if for whatever reason the invoice went out in March, we should really have that recorded in February. So that's the adjusting process. So in the adjusting process, we pulled that information back here. So if we take a look at the accounts receivable and scroll down, we will have an adjusting entry here for, I believe this is the one. This is for an invoice that we recorded. We recorded a journal entry, which is in essence an invoice journal entry. So if we make this date go out a bit, I'm going to hit the plus arrow a few times, go to March. Let's make it 10th or 11th and run that report. Then we'll see the full story here is that this invoice actually happened in March. So this invoice is in March, and the story is that it should have been in February because that's when the work was done, even though the invoice didn't go out until March. So if we select this item, this is our journal entry, that is in essence the journal entry that will be pulling this information back, meaning accounts receivable is going to go up. Just a normal, this is the journal entry for a normal type of transaction for an invoice with inventory. Accounts receivable is going up, sales is going up, the fact that we owe sales tax is going up, cost of goods sold is going up, and inventory is going down. This is actually a pretty complex journal entry, even though it's just an invoice. The invoice is something that everybody makes. Any kind of sales clerk makes the invoice. But what actually is happening when you create the invoice is a little complex, and to set up what is happening and correct it if there's something wrong, and do these adjusting entries really gives a better idea of what an invoice is doing. So that's going to be this side of it. So I'm going to close this back out. And so you can see that this pulls it back into the correct time period in that we pull it back to the month of February, but then we have this problem in that it's in there twice. So here it is here, and then we have it here by March. So it's fine for our cutoff date as of the end of February, but by the time we get to March, now we have the invoice in there and our adjusting entry. And so we have this conflict between making it right for an accrual basis as of the cutoff date and the logistical basis. We might have had a good reason for whatever entering the invoice a little bit later. So now we got to do something to fix that, and what we'll do is just reverse the entry. So we're going to do another entry as of the 1st of March, not the 3rd. We're not going to try to make it exact in the point in time. That means there's going to be 3 days where the financials are wrong by this invoice. We're going to accept that just as a logistical reality. We're just going to say, hey, the benefits of just making it all the reversing entries as of the 1st are greater than trying to make every day correct. And so that's how we're going to work this. Let's take a look at one more side of this. I won't take a look at every aspect of this adjusting journal entry, but we want to look at the profit and loss side. So I'm going to go to the reports, and we're going to go to the profit and loss. And within the profit and loss, we're going to type in the date of 02/02/28 to, yeah, no, that's not right. That's not right. 02/02/21. 02/01/21, February 1st, 2021. 02/28/21, February 28th, 2021, and run that report. Okay, so here we have our cutoff time period again. We're going to run just looking at this month, and obviously our cutoff date is the 28th once again. This is a timing statement, meaning it needs a beginning and an end. And we're talking about something of a sales item. So sales, because we had we sold inventory. So we're going to take a look at this 2,500. And if we scroll back once again, we see the 500 for this journal entry. If we select that item, that's us pulling in. This is that same journal entry, increasing the sales amount as we did accounts receivable. We'd see the same thing in cost of goods sold and inventory. And if we close this back out, if we want to see the full story, I'm going to make this a little bit in March again. Go towards March, go for a little bit in March. And then we're going to say March 9th and run that report. And then if we scroll back down, we'll see more of the whole story here, where we had the 500 made us correct as of the cutoff date, which is the 28th. Maybe I should make one of these cells a little smaller so we stop going back and forth like that. So that is as of the 28th. As of the 3rd, then we have the actual invoice. So we're correct as of the end of the month, but we're not correct for a couple days. On the 3rd. What we're going to do to fix that is have an adjusting entry on the 1st of the new month. All right, let's go back to the profit and loss, and let's check one more thing out, and that's going to be the cost of goods sold account. And that's going to be the expense related to this journal entry that we're going to be working with. And here it is again. Note it's $400. So I'm going to take a look at that journal entry, same one. This is the one we're going to reverse. So we've seen it a few different times now. This is the one that we're going to reverse. Now, just recording this journal entry is a little bit complex. To think about how to reverse it, it's easiest just to look at this one and then do the exact opposite, meaning, we increased the accounts receivable with a debit, so we're going to credit it. We increased sales with a credit, so we're going to debit it. We increased the tax with a credit, so we're going to debit it. Cost of goods sold has a debit, so we're going to credit, and inventory went down with a credit, so we're going to debit it. We're going to do the opposite for the whole thing. Now, if you see this in a book problem, they will probably adjust the ordering of the debits and credits in the reversing process so that the debits are always on top and the credits are on bottom. But it's probably easier just to mirror this exactly. So however you thought to put this here, just do the exact opposite, same ordering of accounts, but reverse the debits and credits. So that's what we will do now. So I'm going to close this back out. And note, we're not going to use a register because this is a complex journal entry, and the register may be able to handle this, but it's a little too complex to try to use the register. The journal entries are really the best way to go. Knowing you kind of have to know debits and credits to really do a transaction like this properly, or at least as easily as possible and properly. So we're going to go to the journal entry. We're going to go to the plus tab. We're going to go down here to journal entry, and we're going to change the dates here to the first day of the next month, which is 03/01/21. All of our reversing journal entries will be as of the first day of the next month. And if you can just memorize that last, or just think about that last journal entry we looked at, we're just reversing that. The first thing that happens in an invoice, we think of an invoice's increase in receivables. So we're going to decrease receivables with a credit. So we're going to type in accounts receivable. Here's accounts receivable. And it's going to be credited for the cost, which was $500, plus the sales tax of $25 or $525. And I'm going to call this a reversing entry. And somehow the caps lock went on. All right, we fixed the caps lock problem, and now we're going to be on the name. Now we have to have a name with accounts receivable because the QuickBooks will not let us record to accounts receivable typically because it'll say, hey, you know, I need to make up a subsidiary ledger by customer, and I can't do that unless you have a name here. And that's going to be a customer name typically, and I think it was string music that this invoice was for, I hope. So that will be the one that we will select. Actually, that's not correct. It was Sam the Guitar Man. Sam the Guitar Man. So once again, we got accounts receivables, the account, and it's going to be a credit to $525. It's a reversing entry for Sam the Guitar Man. All right, then the next side, we typically think of, or I typically think of, the other side going to the sales or revenue account. So the sales typically goes up with a credit because it's a credit balance account. So we're going to do the opposite and debit it to reverse it. So we're going to call it sales of product. We're going to debit it for the invoice price, which is $500. So it's $500. It's going to be a reversing entry. The difference then is going to be the sales tax. Sales tax is a liability typically going up with a credit. So we're going to do the opposite and we're going to debit it. Now, ours is going to go to the California State Board because that's what QuickBooks called the account, California State Board of Equalization. And we're going to debit that for $25. It's going to be a reversing entry. And then we have the other side of it, meaning inventory is going to go down and the related cost of goods sold. So that's going to be cost of goods sold has a debit normally. So we're going to do the opposite and credit it. So we're going to type in cost of goods sold. And that's going to be cost of goods sold. It's going to be a credit for $400. That's the cost, not the sales price. And then the other side is the inventory, which would typically be going down with a credit. We're going to do the opposite and debit it. So the last piece will be the inventory. So we're going to call it inventory. It's an asset account. Asset accounts, it would have been going down with a credit. We're going to debit it. So here's the full journal entry. Remember, this is the reversing of an invoice, so that we don't see this too often, but if you can get this reversing of an invoice, you really are having a pretty good understanding of what an invoice is and how it's recorded. So an invoice typically will increase accounts receivable with a debit, and we're doing the opposite and credit it. An invoice will typically increase sales or revenue or income with a credit. We're going to do the opposite and debit it. An invoice will typically increase the payable we have, which is a credit, and we're going to do the opposite and debit it. An invoice will typically increase the cost of goods sold, the expense for the cost, not the sales price, with a debit. So we're going to do the opposite and credit it. And an invoice will typically decrease the inventory for the inventory we sold at cost with a credit. So we're going to do the opposite and debit it. So we'll save this and see if it does. Now remember the date here somehow changed. It should have been 03/01/21. So it's the first day of the next month. So we're going to save this and see if it does what we believe it should be doing. So we're going to save this and see what happens. We will close this out. Going to go back to our financial statements, back to the reports here on the left side. We're going to run the balance sheet and we'll change our dates once again to 01/01/21 to 02/28/21 and run that report. So here is our report. If we take a look at one of the accounts affected, such as the accounts receivable account, we will then see the activity. And remember that we saw that activity down here related to our adjusting entry, the 525. I'm going to try to make this a little bit smaller if I can grab that. It's going to be the 525, and we then are going to adjust this as of the first day of the next month. So what we're going to do is we pull this in here on 2/28 is scroll back up, and we're going to increase the date once again a few times to, let's say, 3/8 and run that report. Scrolling back down, then we'll see that we've got the 525 happening up here on 228, and then we're reversing it as of 3/1, so it could then be recorded again with the actual invoice. So let's talk about that one more time. Remember that it was originally recorded here. This is when it first happened in time, in March, and it should have been in February. So to make that work, we made an adjusting entry to pull it back into February, but now it would be in there 2 times by March 3rd, and therefore we reversed it right after we made the financial statements as of the end of the month, February. We just reversed it right here. We didn't do it on the 3rd exactly. We could have tried to do that, but we'd rather just make all reversing entries as of the same day, the first day of the next month. We reversed it here, noting that it will be wrong for 3 days. That's okay. And then we're going to have it appear here again on the 3rd, and that's when the actual invoice is recorded. So I'm going to scroll back up and we'll see the same format in the other accounts that'll be affected. I'm just going to take a look at the inventory account. So we're back here on the balance sheet. We'll take a look at the inventory account and see the same activities. So if we go into the inventory, now I've shortened some columns a little bit. It's a little finicky sometimes with the QuickBooks Online, but just you can adjust those and go back in and out to fix those as you please. And then we have the journal entry down here. So remember, we pulled this in decreasing the inventory by that 400. That's our adjusting entry. And now if we increase the date a bit to March, that should do it, March 7th, and run that report, and then scroll back down, then we'll see the full activity. We pulled it back into the end of the month, March 28th, and then the actual invoice happened on the 3rd. So if we had that in there twice, we'd have these 2 negatives. Inventory would be going down 2 times. And that's not quite correct. What we should be doing is, what we're going to do to fix that is reverse the inventory right here with this 400. So it made it correct. We pulled the decrease in the inventory to the correct month. Then we reversed it as of the first day of the next month. And then the actual invoice happened. Let's see that same thing on the income statement side. I'm going to go back to our report. Then we're going to go to the accounting down here. I'm sorry, we're going to go to reports. Reports on the left. And we're going to go to the profit and loss this time. And we'll see the same thing with the sales account and the cost of goods sold. So we're going to make this as of the month of February 02/01/212/02/28/21. February 1st, 2021 to February 28th, 2021, and run that report. So if we scroll back down, we see the sales products. That's the one we want. So we're going to select that, 2,500. And once again, I went in here and adjust the columns a bit. So if we scroll down, we see the 500 here. That's the revenue related to the adjusting journal entry that we pulled in to this month. We did that with a journal entry, not an invoice, because the invoice would happen in March. If we increase the date a little bit to the next time period, that should do it, the 5th, run that report, and we scroll down, then we'll see that we pulled it back into March with this journal entry. The actual invoice happened on March 3rd. So remember the order of when this happened and then the dating order. It happened in time. This actually happened first, but it didn't happen until March 3rd. But the inventory was actually delivered sometime in February. Therefore, we, at a later point in time, entered this journal entry as of the end of February so that we can then record this revenue in February. And then we reversed it as of the first day of the next month so that we can keep this original invoice that we originally entered in March 3rd. So that's going to be the process there. We'll see that one more time in one more account, and then we'll stop this. The next is going to be the cost of goods sold. So we're back on the profit and loss report. We're looking at the cost of goods sold, the 2,000, selecting the cost of goods sold. We see the 400, one same thing. This is the 400, increasing the expense of cost of goods sold, decreasing net income. We made the sale, and therefore the related expense should have happened in February, even though the invoice didn't go out until March. And therefore we need to bring this back into February. And if we increase the date just a little bit, once again, to like March 5th or so, and run that report, scrolling back down, we'll then see that this one, remember, happened first in time. It's increasing the cost of goods sold, decreasing the net income. But the date is later, of course, because even though it happened first in chronological order when we did it, the date was after the actual inventory was delivered, and therefore we needed to pull it back into February. So we did the adjusting entry to pull it into February and be correct as of this financial statement date, and then we reversed it as of the first day after the financial statement date, so that this invoice that we had entered originally will now be the only thing affecting the financial statements as of that point in time. So it's just a timing difference that we're dealing with here, and we're trying to differentiate between just getting things perfectly correct as of the financial statement and just doing things logistically as they're done for the normal accounting cycle.